The Dutch government has taken control of Nexperia, a chip maker based in the Netherlands, to prevent key technology from being transferred to its parent company in China.
The global chip war is heating up again, and this time the battlefield is much bigger than anyone expected. What started as a fight over silicon has turned into a struggle for power across entire industries, from rare earth minerals to oil and even global finance. In Washington and Brussels, officials say they're protecting national security. But in Beijing, this looks like a direct attempt to block the country's rise in technology. The seizure of China's chipmaker Nexperia by the Dutch government has sent a clear message. The West is willing to use Cold War tactics again. That move didn't just freeze one company. It shook the balance of global supply chains. China has spent years preparing for this moment, building its own factories, designing chips at home, and locking in the materials the world depends on. Now, those efforts are paying off. Western sanctions may have slowed progress, but they've also forced Beijing to become more self-sufficient. As Europe tightens control over technology, a new pressure point is forming. Rare earths, the hidden metals inside every chip and machine. And that's where China still holds the upper hand, ready to strike back where it matters most. For years, China has been building something that many in the West dismissed as impossible, a fully self-reliant chip ecosystem. From the outside, it looked like a long shot. But inside China, a massive effort has been underway to close every gap in the semiconductor chain, from chip design to fabrication, from lithography machines to testing and packaging. Beijing's goal is simple: never again depend on foreign suppliers for critical technology. This push began long before the trade war. Back in 2014, China launched its National IC Industry Fund, now worth more than $70 billion, to finance local chip makers and attract engineers from Taiwan, Japan, and the US. By 2025, the country aims to produce 70% of the chips it consumes. Progress has been slower than planned, but not by much. SMIC, China's largest chip maker, recently rolled out 7-nanometer processors using only Chinese equipment, and Huawei's latest phones now run on homegrown silicon, a feat that shocked Washington. Behind these successes lies a huge network of state-backed research labs, universities, and private firms all working under one national strategy. Wages are lower, government incentives are massive, and raw materials are close at hand. Even under sanctions, China has turned restrictions into motivation. Imports of US semiconductors dropped sharply in 2024, yet domestic chip production jumped by over 40% that year. While American and European companies are struggling with soaring costs, new fabs in Arizona and Germany cost up to $30 billion each. China's model thrives on scale and coordination. Its factories are cheaper to build, and subsidies cover nearly everything from energy to equipment. Beijing's message to the industry is clear. If the West closes one door, China will build 10 new ones. That determination is what now alarms Washington and its allies. The Biden administration has extended export bans first introduced under Trump, blocking ASML, Tokyo Electron, and Applied Materials from supplying advanced tools to Chinese fabs. But every new restriction only accelerates Beijing's resolve. With each blocked shipment, Chinese firms are learning to replicate what they once imported. Now that the West has realized how far this program has advanced, panic is spreading across Europe. The United States may have drawn the battle lines, but it was the Netherlands that made the first explosive move, one that could redefine the entire trade war. The move by the Netherlands to seize control of Nexperia, a major Chinese-owned chipmaker, has shocked both markets and diplomats. Using a Cold War-era emergency law, the Dutch government claimed governance concerns as justification, saying the company posed risks to national security. But few believe that explanation. Behind the scenes, this was about pressure from Washington. For months, US officials had been warning their European allies not to let Chinese firms control advanced manufacturing inside the EU. And this time, The Hague complied. Nexperia, headquartered in Nijmegen, is no small player. It produces over 11 billion chips a year, supplying automakers, smartphone companies, and industrial firms around the world. Around 80% of its components are sent to China for packaging and testing before returning to Western markets. Cutting off that flow would hit Beijing's supply chain hard, but it would also cause chaos for European industries that rely on cheap, steady chip imports. The real motive wasn't corporate governance, it was strategic control. By taking over Nexperia, the EU can monitor not just its production, but also its intellectual property and client relationships. European officials quietly admit that they want to prevent Chinese engineers from accessing sensitive production data that could help local rivals back home. In effect, this is Europe's version of containment. But the risk of backlash is massive. China is already Europe's largest trading partner, with total trade exceeding 850 billion euros in 2024. If Beijing retaliates, the Netherlands could face export restrictions on critical materials. Even more dangerous, Dutch companies like ASML, the world's only producer of extreme ultraviolet EUV lithography machines, could find themselves targeted in response. Without rare earth elements such as neodymium and dysprosium, ASML's precision motors and optics would grind to a halt. European leaders are caught in a dilemma. They want to align with US security policy but still depend on China's markets and resources. The seizure of Nexperia may feel like a victory on paper, but it also exposes just how fragile Europe's tech independence really is. And as China weighs its next move, the balance of power in the semiconductor world is shifting again, toward the resources that no Western factory can operate without. China's control over the rare earth industry has become one of the most powerful weapons in this global economic standoff. While many focus on chips and tariffs, the true pressure point lies beneath the ground, in the minerals that make every advanced technology possible. China now accounts for around 70% of global rare earth mining and more than 90% of the world's refining capacity. These elements are essential for everything from EV motors to wind turbines and missile guidance systems. Without them, the West's green and defense industries would simply stall. Europe and the US have been trying to diversify for years, but progress has been painfully slow. In 2024, the EU imported 100% of its heavy rare earths and over 85% of its light rare earths from China. The only large non-Chinese supplier, Lynas in Australia, produces a fraction of global demand. Meanwhile, Beijing has started tightening export rules again. A new regulation requires a special license even if a product contains just 0.1% Chinese rare earth content, giving authorities total control over who gets access. For companies like ASML or Siemens, this is an existential problem. Their high-precision machinery depends on metals such as neodymium, praseodymium, and dysprosium, materials that are hard to substitute and even harder to refine outside China. ASML claims it has stockpiles, but those reserves won't last forever. Each new shipment will be more expensive, slower to arrive, and subject to political approval. The West has tried to respond with new mining projects in Canada, Greenland, and the US, yet refining remains the bottleneck. Building a processing plant in Europe can take up to 7 years, largely due to strict environmental laws and local opposition. Beijing knows this and is using it as leverage. Every new export restriction reminds Western leaders that industrial strength begins with materials, not speeches. Our own community seems to see it the same way. In a recent poll, I asked what would happen if China truly cut off rare earth exports. Out of more than 200 votes, 86% of you said the US economy would blink first. Only 6% believe China's trade position would take the bigger hit. That response says everything about how fragile Washington's industrial base has become, and how much leverage Beijing still holds. With rare earth supplies tightening, the pressure is spreading through global supply chains. Washington knows it's vulnerable, and now it's racing to secure another lifeline further south, in the one region where the next critical resource lies buried. The US Treasury's $20 billion bailout for Argentina has turned into one of the most controversial moves of the year. Scott Bessent called it an economic lifeline, but few believe it was about saving the peso. Behind the headlines, this was a geopolitical bet, a race to stop China from tightening its grip on South America's lithium. Argentina sits at the heart of the lithium triangle, alongside Chile and Bolivia, home to over 70% of the world's known reserves. With global demand for electric vehicles and batteries rising, these salt flats have become the new oil fields of the 21st century. China already dominates the refining stage and has invested billions through companies like Ganfeng Lithium and CATL, securing long-term access to Argentina's deposits. Washington fears losing the region completely. Bessent's bailout was meant to buy loyalty, giving the struggling government of Javier Milei enough dollars to stabilize its collapsing currency. Yet the peso kept falling, sliding another 2% within days of the deal. Inflation is still above 130%, foreign reserves are nearly empty, and Argentina remains trapped in debt to the IMF. Even locals are rushing to sell pesos for dollars, betting the rescue won't last. Financially, the US Treasury is bleeding cash, while politically, Beijing's influence continues to grow. Chinese firms are still expanding lithium operations, offering better terms and faster financing than Washington. What was meant as a show of strength now looks like desperation, pouring billions into a market that can't be saved. And as US funds vanish into Argentina's inflation spiral, a new challenge is already unfolding closer to home, one that threatens America's own energy future and exposes how fast China is redrawing the global trade map. China's latest move has opened a new front in the trade conflict, this time on the high seas. As tensions rise over chips and rare earths, Beijing is quietly reshaping global energy flows. In just a few months, China has shifted billions of dollars worth of oil imports away from the United States and toward Canada. More than 70% of crude leaving British Columbia is now bound for Chinese refineries, while American shipments continue to shrink. In October alone, China bought around 5 million barrels of Canadian crude, a sharp increase from last year. This pivot is no accident. Washington's tariffs and sanctions have made US exports unreliable, while Canada offers a steady alternative at a 5 to 15% discount. For Beijing, it's cheaper, politically safer, and strategically smarter. For the US, it's another painful loss. The energy sector, once a symbol of independence, is now caught in the crossfire. China has also started targeting US-flagged ships with new port levies. Each vessel docking at a Chinese port must now pay hefty administrative fees that can reach several $million per trip, depending on cargo size. The move sounds technical, but its impact is huge. Shipping costs for US crude to Asia have jumped 15% in just 1 week, making American oil far less competitive. For exporters on the Gulf Coast, every shipment is now a gamble between profit and loss. What's more, Beijing's growing investments in foreign ports, from Greece to Malaysia, give it leverage far beyond its own coastline. It can influence docking rights, loading fees, and even customs procedures. In effect, China is building a toll network across global trade routes, turning maritime logistics into a geopolitical weapon. For Washington, this is more than a warning shot. The same country once accused of manipulating trade is now quietly rewriting the rules of global shipping. As America's energy revenues decline and transport costs climb, the balance of power keeps drifting east, toward a nation that doesn't need confrontation to win. The global chip war has evolved into something far bigger, a battle over resources, trade routes, and influence itself. The West may have seized factories, but China has seized the supply lines. Every chip, every barrel, every shipment now carries strategic weight. The US can print dollars, but not rare earths, not oil, not lithium. That's where the real balance of power is forming, not in speeches or sanctions, but in control of what the world can't live without. So what do you think? Was seizing Nexperia worth the fallout? And can US exports survive this shift? Share your thoughts below and stay tuned. This story is only just beginning.